Hey everyone and welcome back. Yeah, the one thing that I know a lot of you are keeping a close eye on right now is the 2024 U.S. election. Well, today we're going to do a deep dive into how the market is reacting to all the election news. We've got a hot off the press market report right here. And let me tell you, there's some pretty interesting stuff in here that will definitely make you think twice about your next stock move.
Oh, yeah, for sure. It is fascinating to see how the market seems to just kind of breathe a sigh of relief,
Yeah.
as the election cycle comes to a close. Actually, we saw this play out just the other day on November 5th, even before we had a clear winner. The stock market had its best day in weeks.
Yeah, it really does feel like everyone was holding their breath and now they can finally exhale. The report even points out that this kind of uncertainty can really shake things up.
Oh, absolutely. If we think back to the 2020 election, that whole drawn-out vote counting process created a ton of volatility. And markets are kind of like us. They crave some predictability. It's not really about favoring a specific candidate or anything. It's more about just having a clear roadmap, so they can plan accordingly.
That makes a lot of sense. Speaking of adjustments, though, the report did mention a recent market pullback. Something about bond yields and earnings outlooks. I know those are key indicators for a lot of our listeners.
Right. So after a 6-week winning streak, the market took a little dip about 2%. It seems like concerns about rising bond yields and then also some adjustments to corporate earnings expectations may have spooked investors just a little bit. But, it's not all doom and gloom.
Yeah, because right in the middle of that dip, the S&P 500 had its best day since September 19th, closing at a very healthy 5,782.76 ounces.
Yeah, and it wasn't just the S&P. The Dow Jones Industrial Average closed at 42,221.88. And the Nasdaq Composite finished at 18,439.17. What's really encouraging is that we're seeing something called positive breadth, which basically means that more stocks are moving up than down. That suggests that this rally has some legs to it.
So it sounds like the overall market picture is pretty resilient, even with all the election craziness going on. But what about specific sectors? Anything standing out from the report that you think would be relevant for our retail investors?
One thing that really caught my eye was that every single sector in the S&P 500 closed in positive territory on November 5th. That's quite a turnaround from the beginning of the week. And leading the charge, consumer discretionary. And it looks like it was fueled by a strong ISM Services PMI report, which is basically a measure of how busy the services sector is. Think restaurants, travel, all that good stuff that people are spending money on these days. We're also seeing solid performance in the automobile industry as well.
So it sounds like people are finally feeling confident enough to open up their wallets again. That's got to be a good sign for the economy overall, right?
Oh, absolutely. And then with falling yields, utilities also saw a nice little bump. Meanwhile, over in Techland, Palantir had a really impressive earnings report, which has sparked some optimism, especially in the semiconductor industry. It seems like their success is a really good indicator of the massive demand for AI technology.
Speaking of those individual stock movements, the report did highlight some pretty wild swings, stuff that I know any stock market follower would want to know about. Palantir's surge was really something else.
It was remarkable. Their stock jumped 23.47%. After they completely blew past earnings and revenue estimates, they even mentioned unrelenting AI demand in the report, which clearly got investors excited. This is definitely a stock I think a lot of our listeners will want to keep tabs on.
For sure. And then on the other hand, we had Boeing, which actually dipped despite the fact that their workers finally agreed to a new contract.
Yeah, their stock fell 2.62%, even though that 53-day strike, which really hurt their production, has finally ended. Looks like the market's still a bit wary about their road to recovery.
Yeah, that's understandable. And then on the complete other end of the spectrum, we saw Marqeta take a pretty dramatic plunge.
Oof, yeah. Their stock plummeted 42.52% after they had to lower their revenue forecast and got hit with a bunch of analyst downgrades. Definitely not the news they were hoping for.
Ouch. That's got to sting. And Archer Daniels Midland also had a bit of a rough time, falling almost 6% because they missed earnings expectations.
Right, and to make matters worse, they also had some accounting issues that actually forced them to postpone their earnings call. Seems like the agricultural sector had its share of challenges this quarter,
Right.
which definitely affected their performance.
And then last but not least, we've got Wynn Resorts, down 9.34%, even though they reported healthy demand. What happened there?
Well, it seems that a drop in operating revenue from their Las Vegas properties kind of overshadowed the good news about their share buybacks and the overall demand. It's a good reminder of how much emphasis the market really puts on those specific financial details.
So many ups and downs. It's like a roller coaster for our portfolios. And with earnings season still in full swing, there's definitely a lot more to unpack. This week, we've got tech giants like ARM Holdings and Qualcomm reporting. And then we also have travel companies like Airbnb. I know a lot of our listeners are really interested in those sectors, so it'll be interesting to see what happens.
Oh, yeah, for sure. Speaking of travel, it's been kind of a mixed bag lately. Airlines and cruise lines are feeling pretty good about things. But remember Airbnb's last report back in August? Not so rosy. We'll have to see if their outlook has changed at all.
Definitely. And let's not forget about Qualcomm. They had an absolutely killer previous quarter with double-digit growth in their smartphone processor business. Can they keep that momentum going? That's the million-dollar question.
Absolutely. And then there's ARM Holdings. Their stock actually took a bit of a hit last time around because analysts thought their guidance was a little too conservative. So they've got a lot to prove this time around. It's almost like a test of investor confidence.
For sure. It feels like the initial excitement of earnings season is starting to fade just a little bit. The report mentioned that fewer companies are beating expectations, and earnings per share growth isn't as strong as it was. Is this something that our listeners should be worried about?
It's definitely something to keep an eye on, especially with the S&P 500's price-to-earnings ratio sitting at above 21, which is historically on the high side. What this basically means is that investors are paying a premium for earnings, so those earnings really need to deliver.
Okay, so what are analysts predicting for the rest of the earnings season? Are they factoring in all this selection uncertainty?
Well, it's interesting. A lot of analysts seem to be holding back on making any big predictions until we have those election results, which makes sense, right?
Totally. I mean, the outcome of the election could have a huge impact on things, like tariffs and tax policies,
Yeah.
which would obviously directly affect corporate earnings.
Exactly. So once the dust settles and we have a clearer picture of the political landscape, then I think we can expect analysts to come out
Yeah.
with their revised earnings estimates and market predictions. It's like they're waiting for the game plan to be set before making their moves.
Makes sense. Speaking of game plans, we can't forget about the Federal Reserve meeting that's happening this week. I know the election might be dominating the headlines, but the Fed's decisions have a massive impact on the market, especially for those of us with investments that are tied to interest rates.
Oh, absolutely. The market is definitely on the edge of its seat. Waiting for their rate decision on Thursday, everyone's trying to figure out if they'll cut rates, and if so, by how much. Remember last month they surprised everyone by cutting by 50 basis points.
Right. So what's the consensus this time around? Are we expecting another big cut?
Well, according to the CME FedWatch tool, which is kind of like a crystal ball for Fed decisions, the market is predicting a 25 basis point cut. But not all Fed members are on the same page here. Some of them weren't too keen on that big cut last month, so there's always a chance for surprises.
Okay, so things could get interesting. And with 2 more Fed meetings still on the calendar this year, I'm sure the market will be watching their every move, especially after that softer-than-expected jobs report that we saw in October. Do you think we could actually see 2 more rate cuts before the year is out?
Well, if we look at some of the recent economic data, there are definitely some signs pointing in that direction. For instance, the ISM Services PMI for October was incredibly strong.
The report actually called it a 2-year high. That sounds pretty significant.
It is. It came in at 56%, way above expectations, which suggests that the services sector is expanding at a very healthy clip.
Okay, that's definitely a positive sign. And what about that Treasury note auction? The report mentioned that it was kind of a big deal.
Yeah, that $42 billion 10-year Treasury note auction went surprisingly well. It attracted strong demand from investors, even with all the concerns about those high debt levels and all the government borrowing that's been going on.
So does that mean that investors are still confident in U.S. Treasuries?
It seems so. Those strong auction results actually help to push down yields, which is usually good news for the market.
Okay, so we've got strong economic data, a successful Treasury auction, and a potentially dovish Fed. But let's not forget about the big question mark hanging over everything, the election. How are investors likely to react to the outcome, regardless of who wins?
That's the million-dollar question. While markets generally prefer certainty, I think the real focus will be on the policy implications of those election results. You know what changes are coming, and how will those changes affect the market?
So investors will be less concerned about who's in the White House
Yeah.
and more interested in how their policies will impact their portfolios.
Precisely. For example, changes to tax policies or trade agreements or regulations could have a huge impact on specific sectors and companies. Think about how a new trade deal could shake things up for manufacturers or exporters, or how changes to tax laws could benefit some companies while hurting others. It's all about understanding those ripple effects.
Yeah, it's like a giant game of chess. Every move has consequences that ripple across the entire board.
Exactly. And that's where the real challenge lies for investors, being able to see beyond those immediate headlines and connect the dots between seemingly unrelated
So
events.
it's not just about picking the right stocks. It's about understanding the bigger picture and how all these different pieces fit together.
Precisely. It's about developing a well-informed perspective on how the world is changing and how those changes might impact your investments.
Wow, that is some serious food for thought. It sounds like the most successful investors are the ones who can kind of anticipate those long-term trends and position themselves accordingly.
Absolutely. It's about being proactive, not reactive. It's about understanding the forces at play and making informed decisions based on solid research and analysis.
Okay, so we've covered a lot of ground here. Market reactions to the election, economic indicators, key stock movements, and the upcoming Fed meeting. What are some of the key takeaways that you think our listeners should keep in mind as they navigate this uncertain market?
Well, I think first off, it's important to remember that the market has shown incredible resilience. Even in the face of all this election uncertainty, I mean, we saw a strong rebound after that little dip we talked about, with all S&P 500 sectors actually ending the day in positive territory on November 5th.
Yeah, that's right. Even with all the drama unfolding, and that strong performance in the consumer discretionary sector really tells us that consumer confidence is holding up pretty well, which is a big deal for the overall economy.
Exactly. And second, I think we need to acknowledge that the economic data that we're seeing is mostly positive. The ISM Services, PMI, hit a 2-year high. And the success of that Treasury auction tells us that investors still have faith in U.S. debt.
And let's not forget about the Fed. They seem to be leaning towards a more accommodative stance, which could mean more rate cuts in the future.
Right. That's definitely a key takeaway for our listeners. So all these factors together, they paint a cautiously optimistic picture for the market in the short term. However, the long-term outlook really hinges on those election results and the policy changes that follow.
So the real question is, how will the election results impact specific sectors or companies in the long term? What should our listeners be thinking about as they plan their investment strategies?
That's the million-dollar question. It's all about anticipating those ripple effects. Like, for example, imagine a scenario where we have some new trade policies implemented. Well, that could have a major impact on companies that are involved in manufacturing or exporting goods. Similarly, changes to tax laws could be a boon for some companies, but a real headache for others.
It really is like a giant game of chess, where every move has consequences that ripple across the board.
Exactly. And that's where the real challenge lies for investors, being able to kind of see beyond those immediate headlines and connect the dots between seemingly unrelated events.
So it's not just about picking the right stocks. It's about understanding the bigger picture and how all these different pieces fit together.
Precisely. It's about developing a well-informed perspective on how the world is changing and how those changes might impact your investments.
Wow, that's a lot to think about. It sounds like the most successful investors are the ones who can anticipate those long-term trends
Yeah.
and position themselves accordingly.
Absolutely. It's about being proactive, not reactive. It's about understanding the forces at play and making those informed decisions based on solid research and analysis.
Well, this has been an incredibly insightful deep dive. You've really helped us make sense of this complex market landscape and given our listeners a lot to consider.
My pleasure. I always enjoy breaking down these market dynamics and exploring those potential implications for investors like our listeners. It's all about empowering people to make smarter decisions.
And we appreciate you sharing your expertise with us today. Remember, everyone, the market is a constantly evolving beast. Stay curious, stay informed, and keep diving deep into the world of finance. Until next time.